a very relevant, evolving subject: frauds in Indian securities market, patterns, pitfalls, and prevention. Friends, as you are aware, that Indian security market has witnessed series of progress, development, and growth. But simultaneously, it has seen the high-profile, large-scale frauds over the year. And these instances and recurrence are replicate continuously in a different form. We have seen earlier Ketan Parikh's Harshad Mehta scam, then IPO, then penny stock, LTGC, liquid stock reversal trade, demat scam, international security, GDR issue, then pump and dump, and then WhatsApp leak scam, NSC collocation, fictitious revenue creation, that is a always it is there, accounting fraud, which is always there, and insider trading in different form and front running. So friends, today's webinar's object is that we want to explore the common pattern and typology of securities market fraud and red flags for investors and professionals that they must watch, and they must see that how the system is evolving. So how you have to protect yourself, your client, and your dignity also. At the same time, the regulator will also do something, because always fraudster is always ahead than you. When fraud is taking place, we are reacting on this. Now time has come, we have to have proactive on this. Like a ethical hacker, which various companies appoint them and ask them that you just identify the shortcoming in their system. Same time, you have to do that. Whatever frauds are taking place, you have to protect, but whatever will come in future, that also you have to see. So we have to see the real world case studies, legal insight, participation. Those who are attending today, they must understand that how the fraud occurs, what are the loopholes, and how these people do, and how the preventive mechanism can come, and what are the new types of things coming. So investors should be aware. Professionals should be alert. Corporate independent directors and boards should be alert. So today we want to discuss common type of frauds in securities market, patterns and red flags, regulatory framework, and enforcement actions, impact of frauds on investor and market integrity and economy, best practices and prevention, risk mitigation, and then some case studies which we'll do. So today's program, I welcome my all distinguished speakers, and I want to especially welcome Sundareshan sir. He is coming after serving SEBI for more than 40 years. So he is today's chief guest, and he has done so many investigations, so many identified fraud cases, and passed an order, done as an investigation head also. He has done this. So Mr. Sundareshan is a former executive director in SEBI. He is seasoned securities market regulator with a legacy of over 36 years in SEBI, joining the organization in 1989, when was the first batch joined. Just a year after his formation, 88, SEBI came. He joined in 89. His journey reflects a rare combination of regulatory depth, policy innovation, and underweaving integrity, raising from junior officer to executive director. That is his most important learning to all professional, all people, and we all friends also. His leadership has been pivotal in shaping SEBI's reputation as a globally respected institution, because when he retired, he has worked with all chairmen of SEBI since 81, Mr. G.V. Ramakrishnan to the present chairman. He has worked. So many things he has given. Consistently, he's rated outstanding performer in SEBI. he has led key reforms across primary and secondary markets, surveillance, enforcement, and IT. And not only this, he has initiated so many things first time in SEBI. His vision for SEBI is future ready. He is not reactive, he is a proactive. He anchored in data-driven service supervision, surveillance. Technology adoption is his core area. Investor protection and ESG readiness is always there. His career is a testament of regulatory clarity, which you can listen from him today. Institutional resilient, that what he has learned in this, and people first policy, always thinking, that is very, 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 very important, which we should understand. So I welcome Sundarshan sir. We are now you have coming to this side. So today's topic is for you a very different note and different style you have to work out. So welcome, sir, and thanks for accepting our invitation. Then I welcome Mr. GP Madan. He's a founder and managing partner of Madan Law Office. He has been over 30 years, 3 decades of experience in corporate legal advisory, litigation, governance, capital market, and now expertise in insolvency law. He has served as a chairman of ICSI NIRC, co-chair of ASSOCHAM National Council of M&A, and he's associated with the NCLT and IBC committee of PSD CCI, and he's chairing recently the PSD Chambers Insolvency Committee. I welcome Madan, sir, for this program. Then
thank you, and namaskar to Sundarshan sir.
Then we have a Ravi Prakash, associate.
Thank you to all.
Associate partner, Securities Law and Corporate Litigation, corporate professional, and I welcome Ravi. He's just joining. Then Ms. Kirti Karan, she's joining first time. She's Associate Security Law and Corporate Litigation, corporate professional, and she's handling so many cases relating to this. So friends, this is today's introduction of our speaker. Before starting, I just want to give a preliminary point, because this is one of the very interesting topic, and I was in capital market since 1992 when Harshad Mehta scam came, so I am aware of all these things which has taken place. Somewhere we have seen this journey, and I just want to discuss the fraud on a different parameters, how the fraud is affecting the economy, and what we should be reactive. So I'll just give you my presentation on this. My first is fraud in Indian securities market, patterns, pitfall, and prevention. So what is most important question today? What is the most valuable asset in any security market? That is trust, not the money. So this is the trust, and how the wealth creation, because stock market is a manufacturer of liquidity. Because the wealth requires, whenever they want to sell, they can sell. So a stock exchange is always working, creating liquidity. It's a manufacturer of liquidity. Always I prefer this statement. For that, wealth creation engine is also capital market. So how the trust power national prosperity, that is one angle which I have designed this. So trust, investor confidence, investment, capital allocation, capital formation through equity and debt market, and enterprise growth, business expansion when they have money, and the national prosperity when GDP and employment takes place. So every rupee invested in a trusted market creates multiple rupees of national wealth. That is one part. And we have seen this. You start one engagement, and the ecosystem creates so many new things. So Indian capital market today is $4.5 trillion. Retail investors are 17 crore. Listed companies are more than 5,000. So this is structure. Now fraud. What fraud is doing? The fraud wealth destruction is a mechanism. So there is a fraud. First impact of fraud is trust erosion. Second is Because of the trust, investors lose money, so they exit. And that's why the capital is also vanished. Because investors are not there, the capital will not come. And this investor is not only the retail investor, the big investor also. And then if capital is not there, economy damage is taking place, then the burden and load will come on the banking system, and banking system cannot do the risk capital. So we have seen this 1.25 lakh crore rupees estimated loss in major frauds taking place in 2024. 40% market capital erosion after the major fraud taking place. Average time for market confidence to regain is 5 to 7 years. That is the case which we have seen in the past. Now, next is why fraud matter, the trust cost. Retail investor, they had life-saving investment and they lost money. Retirement disrupt, behavioral scare, fear of equity, and they don't want to invest. They want to invest in fixed deposit. Fixed deposit is not creating any capital, and confidence loss. Companies higher cost of capital because they have to capital is different. It is not upfront money you have to pay. A higher cost of capital they have to pay. Valuation discount they will get because when there's no demand, then the discount valuation will take place. Reputational damage and governance premium demanded because always everybody wants that you should have multiple governance parameters. What are the impact of capital market? Liquidity decline. That is one part because people are going out. Volatility spike, and then impact costs goes up. Price distortion is also taking place, and FPI confidence erosion, and they also run away. The entire impact in Indian economy will be of this fraud: reduced capital formation, FDI, FPI deterrence, entrepreneurship. They are also not taking any innovative step, and GDP contribution is also reduced. So this is the impact of fraud which is taking place. This is the true cost to all, not the one retail investor, everybody. Ultimately, the economy. Next. Fraud is not a crime against one investor, that is one part, or investors. Fraud is crime against national wealth creation. That is the clear-cut impact of last 20-30 scams which has taken place. Every act of securities fraud attacks the prosperity of every Indian citizen because your system will go down, the taxation will go down, the impact will go down, everything is affecting the economy. Next. Now, if you see evolution of these frauds, so I'm not going to detail because other people will cover. I'm just telling you in 90s, operator driven fraud was there. Then Harshad Mehta, banking and other manipulation because banking loopholes. 2000 network driven. Ketan Parekh, they have a K10 stocks circular trading. They were doing stock price manipulation. 2010 technology enabled algo abuse, co-location fraud, digital layering. So that is another things that step in place. 2020 digital ecosystem, WhatsApp tape, in financial influencer, they have come out, social media and various other Telegram channel and other thing they were doing. 2030, the future. Now there AI is coming. People are calling in my name, in my language, and my voice, and with my photo, so you can understand what all deep fake news, algo manipulation, synthetic entities will create in future. And that's why the regulators should be ready for these types of things, and they have to simulate today itself that what types of things will come and how to prevent this. So fraud evolve faster than regulator. It is always correct. But today, innovation is tomorrow's loopholes. That is also there. But the today regulator has to be more agile and more active. Next. How the fraudster thinks. Fraud. Number one. How the opportunity will come. We control, they identify, arbitrage they identify of this legal loopholes, regulatory gaps they see, and information asymmetry that they will see. This is opportunity. Then pressure, let's say coming from the greed, financial need, excess ambitions, and bonus targets. That is another. And then revenue target, the ESOP and other valuation that we have seen in Enron and other companies. Rationalization, everybody does it. If I'm doing, so what is the wrong in this? And I deserve more. If you're not giving, I'll take away. One time only, I'm doing only once. And sometimes people think nobody's seen. So behavioral trigger is there, the authority wise. Sometimes trusting expert tips blindly. They are sitting somewhere and people are following them. So they use that particular expertise. Like TV channels anchor, they have done this. Some of the people, those who have created their own system, own influencer, they were doing. Herd mentality, following the crowd into traps. That is, they are aware that how the, if I will do, other people will also do without realizing anything. FOMO, fear of missing out. Otherwise, this is the biggest logic. Overconfidence. Fraudster thinks that they won't be caught. Never. So that is the behavioral issues with the fraudster. Next. Now, fraud is a universe. It is not that in India it is taking place. Market manipulation, insider trading, cross-border fraud, digital social media fraud, accounting fraud, IPO fraud, broker intermediary fraud. These all frauds has taken place. This is the complete map if you just see this. Next. These are the cases. Harshad Mehta, what happened? He has identified loopholes and lesson learned because SEBI came into this electronic system. NSE started, dematerialization started, and real settlement. So this is one point. And here Sensex fall 40%, 5,000 diverted, 27 banks implicated, lead to creation of modern India capital market infrastructure. That credit goes to Harshad Mehta scam. Next. Then Ketan Parekh, he built up some script, he manipulated, then market collapse. And these stocks which are where he has K10, 80, 90% there, and then crash. Banking, those who were depending upon, they have taken a margin, they lost heavily. And after that, NSE banned, aid broker, JPC, Proof, SEBI strengthened, Global Trust Bank merged with OBC, and various circular trading issues and FUTP definition has changed, and bank and broker firewall has created. That is another point. Next is that is the today the NSE co-location 15/2019, the preferential system given by some few people. Certain broker received some milliseconds data before the others. SEBI penalized NSE by 625 crore rupees. And lesson is even infrastructure can be fraud vector. Then Fluencer, the SEBI action 16 entities, 72 crore rupees disgorgement and penalty. And Telegram, WhatsApp group, lakhs of subscriber base use this. Buy signal sent, stock pumped, operator dumped. All these things has taken place. So lesson, social media reach is a new market manipulation infrastructure, and that is also very, very serious because control is not there. And Sundarshan sir is here. He has passed so many orders and he has done investigation of these type of pump and dump cases. We will listen from his side also. Next, if you see the red flag heat map, who must watch what? So if price movement is going, so there are investor, board, audit committee, compliance, and then market merchant bankers. So usual price movement investors should see. Related party, board and audit committee and compliance should see. Earning quality decline, that time board, audit committee and compliance should see. Promoter pledge surge, investor must see that something is happening, they should not invest. Compliance team has to see, auditor qualification, board, and everybody has to do except investor, because but investor should read this. Disclosure delay, if it is happening, then everybody should be alert that why this is happening. So this is a heat map of red flags. Next. Now, prevention architecture, 5 lines of defense. First, investor, they should, financial literacy should be there, due diligence should be there, and they should be very skeptical. Savvy investor education is there, checks score and verify intermediaries. That is very, very important. Management, because companies management is also, sometimes they say we are not manipulating, other people are doing, so they must do something, ethical culture, internal control, whistleblower mechanism. So that's why code of conduct, UPSI, and vigilance mechanism is there through SEBI. Board, strategic oversight, audit committee, accountability should be there. And board evaluation, related party scrutiny, and auditor independence. That is the part which law has uh, come out in this. Then intermediary due diligence, KYC, AML, sustainability assessment. That is also there. Merchant banker check, broker surveillance, value independence. That is also SEBI has done. Regulator, they should do market surveillance very effectively and proactively. Enforcement, deterrence should also be there. SEBI score, intermediary surveillance system, enforcement action. These are the points which are defense. So each line must be independently strong. When all 5s are active, then I think it is nearly impossible that somebody is doing fraud. If anything is weakened, then the fraud takes place. Next. Then come to the governance shield framework. Accountability, transparency, disclosure, ethics, technology. These are the governance shield. So the governance shield is built layer by layer. Remove any layer, the entire structure will weaken. So that is the part 2 of the earlier slide. Next. Now, where is the call? What people should do? Director and ID, they should be actively do review everything. Whistleblower, they must respect, and they analyze that if something is happening wrong with the script, they must do, which normally stock exchange and SEBI is asking, board should also ask. Compliance officer also map 5 fraud exposure like insider trading, front running, and various other things which are taking place. They must do UPSI, very strongly follow, and run annual fraud scenario simulation. That is the future which compliance officer should do. That any fraud is taking place is anywhere, they must check whether this is possibility in our office or not. Investor, they verify all investment tips before investing or before going to the just investing, just see something wrong is not there. Register score if there is any grievances there. Check SEBI debarment of brokers and other investors, and anything which is giving unreasonable return, you should be cautious. Market professional, they should adopt ethical things, because I have told you this earlier, that your fraud is not your benefit, you are damaging the country. Report suspicious pattern immediately if you know. Invest in technology driven compliance tool, that is also. So be the guardian of trust that Indian capital market deserve. That is very, very important. Next. Now, next, Shivam, next. So next frontier, future fraud risk, 2025 to 30. I have just identified some. AI generated deep fake announcement. Suppose fake CEO video announced that this company is doing this company is doing this, and the next day share price is going up. Fabricated earning calls, synthetic investor presentation to move stock price, and then you are buying and they are selling. So this will happen. This is the likelihood, and this is the potential impact which will take place. 90% think, 85 and 95. Algo manipulation, high frequency trading algo designed to create artificial price pattern that can take place. Synthetic identity fraud, AI created investor identity bypass KYC system, another thing, and they can create this. Cross-border digital fraud, which is taking place. Today, I got my team got a message that I want to talk to them, and some other email, some other number, and then we inquired. We came to know this is an international number of BPN was used in this. So people are doing and using cross-border fraud things. Quantum description risk, that is also quantum computing breaking encryption on financial system, and future threat is also there. So AI is good, but it is bad also, and it will be helpful for the future fraudsters. Next, the technology as a fraud guardian. But now simultaneously, you have to follow technology, AI and machine learning. You have to use this so you can detect 99% correct surveillance. Big data analysis, you have multiple data, use it, see the pattern, see the announcement, how the social media and people are doing without connecting to the reality. Social media surveillance should also be there. Uh, the NLP system should natural learning process should also do this. And 16 savvy influencer action in 2024, that was a part of this particular social media surveillance. Blockchain audit trail must start, and the settlement cycle T+1, that is also one of the reason that things can take shape. So that advantage of that technology we should use. Next. Now, what regulator should do? Regulatory response and way forward, that is also there in this fraud. So 360-degree reform agenda across law, technology, infrastructure, and gatekeepers. Next. So first is the 360-degree four pillar, three horizon, law and enforcement, short term, three-tier case classification, technical, medium, and severe. SEBI must do this, because today what is happening, technical and medium merge with the severe, and then it loses its credibility. And you are taking the same time to handle the technical case and medium case, and say the way severe case is there. So that is one. Immediately it should start. Penalties linked to fraudulent gain from with the multiplier, not with 1 crore or 2 crore. If you have created a loss, 5 crore, 20 crore rupees or 3 times penalty, 15 crore should be implemented. A special security fraud bench and court should be established, so case should be filed. So 3 to 10 years this can be done. Technology early warning system, AI, ML, machine learning for spoofing, layering, pump and dump detection should be there. Fraud early warning grade, SEC, FCAMS, Corporation, International, this should be there. And AI Market Integrity Center and deepfake detection should be there. Infrastructure and case management, central fraud database and pattern and repeated offense should be make uh, very popular. SEBI, RBI, ED, SFIO, FIU data exchange should be there. And it is there, but it should be known to the public at large, the fraudster at large, that you are doing something here, it can come. Securities Fraud Intelligence Unit, fraud heat map should also be created. And whistleblower gatekeeping, that is also anonymous digital portal with the reward framework, that is there today. In this program also, I have received one whistleblower complaint also relating to one case which is recently going on, and he has mentioned, and which I will pass on to SEBI. SEBI gatekeeper registry and graded section, whistleblower payout linked to the penalty proceeding should also there, so more and more people should be encouraged. From episodic enforcement to a permanent national market integrity architecture should be created if we want to create a 360-degree regulatory framework. Next, the reforms, technical, the graded enforcement, which I told you, procedural lapses, fast track consent, low fees, quick closure, and no time wasting. Medium negligence and repeat lapses, graded penalties, and monitoring. Severe fraud, willful default, fast track enforcement, gain linked penalty with multiple prosecution, that is there. If we can do this technical, medium, severe, I think we can do big change and bring out new fear in the market of fraud, in the mind of fraudster. Real-time intelligence stake should be created. AI ML pattern engine should be clear. Circular trading, pump and dump, social media, sentiment radar, unified fund flow view, exchange depository, bank data should be merged or should be integrated. Global cooperation should be there, and RegTech sandbox we must create it, which SEBI is doing with the latest data. Next. The destination, India's market integrity architecture 2030. First is Securities Fraud Intelligence Unit should be there. Dedicated analysis, quarterly fraud heat map, and by sector and script, gatekeeper registry, track record, score of trade, auditor, banker, rating agency, blockchain compliance calendar should be there. Special securities fraud code should be there, and no doubt set is there, but some cases are going to other part of this that is also connected, or we should have more and more benches of this fraud simulation lab. That was I was saying, you should predict in advance what is happening. AI investor risk radar should be created. Personal fraud risk alert for 17 crore and retail investor should be given, because you have an email address of all. We can send what is happening, so people should show. So indicative blueprint for discussion. The question is not whether to build this, but how fast, that is important. So this is the important thing, friend. Now, next, India is thinking that we should go to 2027, India 100 years, and we will be developed country. So if the developed country is there, so you have one very important thing. Can India become the world's most trusted capital market? If you want to be developed country, this is essential. 500 trillion market capitalization, 100 crore investor base. That time capital is 140. It will also increase to 160. Global #1 corporate governance index, and zero systematic fraud tolerance. If we can do this, the trust dividend will be more trust, more investor, lower cost of capital, more entrepreneur, and more growth of the country. And we will be really developed country. In the every boardroom, this question should be asked: what are the 3 structural reforms that would make India's capital market the world's most trusted by 2047? They should suggest normal point and their company's point of view, that how you are protecting your investors. And at the last, we must see this, that trust dividend, more trust, governance, transparency, technology, and accountability. More investor, domestic, retail, institutional, foreign. Lower cost of capital, wider investor base, compress equity and debt risk premium. More entrepreneurship, access of capital and employment and business creation. And taxation. More growth, higher GDP, per capita income, and capital market ecosystem is going up. More prosperity for everybody, rising living standard of all countrymen in the country, because you will get employment, you will get more money, you will get more tax, and get more better infrastructure. So friends, my point is very simple. Market are not built by money. The capital market is built by trust. Fraud destroys trust, governance protects trust, and trust creates wealth. That is the final verdict from my side, which I want to just tell. Because this was very, very topical subject and very interesting, and I'm always, for Sundarshan sir, I have taken so many classes of SEBI team also on this corporate fraud in the past. And we have done so many research also on this particular thing. That's why I was a little bit passionate about this. So friends, I have given a broader and different connotation. Now come to the topic, and let's listen from Sundarshan sir the main content of our today's discussion.
Good evening to all of you. Mr. Pawan, am I audible?
Yes, sir. Yes, sir.
Okay. Thank you, Mr. Pawan Kumar Vijay, Mr. GP Madan, and the team corporate professionals for inviting me once again to this webinar. It's really heartening to note that this has been continued regularly by you for the last almost more than 5 years. And what fascinates me about this webinar is that the divergent topics which you cover over a period of time. It's not restricted to securities market. It is covering all the financial sector related topics and even non-financial sector related topics. So I wish you all the best. And once again, thank you for inviting me for this important topic of the day. So I do not know whether it is a coincidence or is a default or by design that in the last couple of weeks the media is full of second matters related to securities market, the orders passed by the Supreme Court as well as the orders passed by SEBI, and it has been widely discussed. What type of investigation is being done, what type of evidence has been collected, how they are being presented, and so on and so forth. So, before I get into the topic of the frauds in the securities market, so first let me tell you that, as you rightly said, how the market has transformed. What it was during 90s, what it was during 2000, and especially the post-COVID. If you take the entire market into three different buckets, I can say that over a period of time, a lot of reforms have taken place. And today, the Indian securities market is definitely much more matured than it was 25 years back. It is definitely more modernized, whether you take on trading, whether you take on investment, settlement, whether you think of the investor awareness and education. So, and third very important thing is definitely not only the Indian securities market, the entire financial system is completely integrated with the global system. So we have an integrated economy as such, rather than it's not only an integrated securities market. And because of this integration, the situation has become more complex. So the market, because of the number of investors, the number of products which are being traded, and coupled with the technology which has been used, because everybody wants to do a fast trade, a fast settlement, and to make money in a faster manner. So it has become more complex. But at the same time, I must say that the regulator has been taking necessary steps over a period of time. And because of that, I must give credit to the regulator as well as to the market infrastructure institutions and other market participants who have been cooperating with the regulator in ensuring market integrity. The Indian securities market has become very strong, and operationally very resilient. That we have seen during the COVID, and even after the COVID, whatever is a geopolitical situation, there is no default as on date. The resilience is definitely noteworthy. Similarly, all these things were possible because the regulator has put in place appropriate risk management system, surveillance, as well as enforcement mechanisms. Now, all these things are in place in addition to I must give credit to the investors for their ability to enhance their awareness and take care of themselves, because it is not merely putting the system in place. People must be in a position to understand the system, adapt, and use them. Now, you simply put this in English, then let me tell you by giving some statistics how the market has become so big. Today, the number of order messages which are coming into NSE on a per day is close to 20 billion plus. And see the speed at which these orders are being goes for execution. And out of these 20 billion orders, the number of trades which actually takes place per day is close to 25 crores plus. And the number of securities which are traded is close to 3,500 on an average. And how many investors, unique investors, are trading in the system is close to 12 to 13 crores per day. It's on average. To take on a particular year, 24, 25, or 25, 26, the number of unique investors trading in the system is close to 13 plus crores. Similarly, the number of contracts which are being executed in derivative segment is close to 20 billion per day. So if the market size is so big, there are bound to be certain aberrations because the market is meant for making money. So the people who are entering into this market, they are not coming for charity. They are definitely coming with a clear intention to make money. Making money is the main and the only objective in securities market. Even in multiple orders of Supreme Court, they have clearly said that nobody comes to the market to incur loss. The aim, the objective of any investor who is entering securities market is to make money. So when there is an intention to make money, and that intention goes beyond a tolerable level, then it becomes greed. So because of greed, these types of frauds take place. Now, what did SEBI do to ensure that the market integrity is maintained? Because market integrity is very critical for the well-functioning and efficient securities market. So as most of the participants in this seminar will be aware that SEBI has put in place an excellent risk management system for orderly trading and settlement, and that is why there is hardly any settlement issues taking place in the system. Whatever trades take place, they get settled. The investors are informed immediately when the transaction takes place, so that the investor is aware that his transaction has been taken place as he desired and not by somebody else in some other form. Similarly, in order to ensure that corporates are making proper disclosures, SEBI has put in place very strong disclosure standards. And in fact, in a number of places where I have gone, even with the international participants, they accept and claim that the disclosure standards in India is much higher than what it was in the global standards. At one point of time, we were trying to adapt what the global standards were as far as disclosure is concerned. But today, the fact is, our standards are being looked as very high, and there are certain jurisdictions where the companies want to come and list in India. They are approaching us asking whether our disclosure standards can be relaxed. So that is the level we have reached. The purpose of putting all these things is to ensure market integrity. And of course, as I said, investor education has been done from time to time. Now, with all this, as you rightly pointed out, the market is definitely because of greed, sometimes certain what you call undesirable elements do certain things which brings what you call discredit to the system. As you rightly pointed out, the entire securities market survives because of trust. Now, fraud is exactly opposite to the trust. If you have mostly rather highly trusted market, the number of such incidences has to be low. Therefore, whatever, as Mr. Pawan said, the fraudsters have also changed their methodology over a period of time. So I don't want to dwell into the types of frauds or the modus operandi which took place in early 90s or in 2001. Now, let me focus on post-COVID, the type of frauds which are taking place, where how SEBI has also enhanced its infrastructure to address the concerns arising out of these type of frauds. So I will put the types of frauds which have been taking place post-COVID, that is in the last 5 to 6 years, in 3 different buckets. The first one, according to me, it is called information-based. People who are aware of certain information which the other market participants are not aware, they take undue advantage of that additional information which they have, and the cost of the other investors make use of that to make money. Okay, so that those types of frauds which we categorize as front running and insider trading, these are basically information based. The second one is that financial statements related, where certain companies, due to knowingly or unknowingly, design their financial statements in such a way that they do not reflect true and fair picture of the company. There are a number of cases, whether it is Gensol, it has started from Satyam almost 20 years back. But now such cases are continuing, whether it is the DHFL, whether it is the Yes Bank, recently Rajesh Exports, which have been in the news for quite some time. So here it is difficult to say whether the financial statements have been made with an intent to deceive the investors or it was done with some other purpose. So this is another set of fraud which is taking place in the last 5 years because it has become easy for people to do it because they have different software for showing it to the auditor, different software for disclosing to the stock exchange. So technology has enabled them to do all these things. Now, the third important aspect type of popular, what you call market fraud is that market manipulation using the social media. Now, this is another aspect where the technology has been used not for the right purpose but for the wrong purpose. Whether it is the business channels where people come and talk something and to buy or sell, make some recommendation, but they take a different type of position in the market without disclosing their actual role in the particular script. Similarly, people use Telegram, people use Twitter, people use Facebook. They come and project certain things about a particular company, or they say that company has won some big contracts, uh, deceive the investors without sometimes with the knowledge of the company, sometimes without the knowledge of the company. So this is the type of fraud which people do it, and according to me, all these things have become more popular, especially post COVID, mainly because information was able to be shared faster than what it could be pre 2020 because of technological advancement and the way Indian public, Indian investors are adapting technology faster than any other country. So, what did SEBI do? Now, when we know that this type of what you call frauds are becoming, in the system. So the first aspect is that how do we prevent? Because as we all know, prevention is better than cure. So the first step SEBI has done is that we are putting a robust surveillance mechanism. Now, what do you mean by that surveillance mechanism is that if someone wants to manipulate using the stock exchange mechanism, the cost of doing that must be very high. It will not be possible with a small amount of money for someone to enter the market and then do mischief. Therefore, one of the ways to do is to increase the margin where people have to bring more money in the system if they want to, attempt to do something wrong in the system. So, depending upon the movement of the stock price, depending upon the volume of the stock, depending upon the concentration in a particular stock, and taking into consideration the liquidity, SEBI has put in place different types of surveillance measures. One we call it as additional surveillance measures, depending upon the scripts or where it is liquid, where the scripts are not very liquid. Then, based on the fundamental factors, SEBI has put in place graded surveillance measures in order to ensure that fundamental factors are taken into account in the price movement. Even after that, when certain price aberrations were found, certain scripts were moving at a what you call astronomical speed, SEBI has come with enhanced surveillance measures. Under that, the shares are allowed to be traded based on a call option and also compulsorily put on trade for trade so that even if somebody brings more money, it is not possible for him to jack up the price so early and then do a pump and dump type of thing. So this is basically from the perspective of surveillance. Not only that, we have also enabled the stock exchanges as a first-line regulator to impose additional margins in case they find some aberration in the trading in a particular script. So this is whether it is in derivatives or in cash market. Now this is one side of that. Despite all this, it is as we know, this is a market where people are coming to make money. So the greed is always there. So when there is a greed, people will find ways and means or gaps in the system or gaps in the regulatory roadmap to what you call commit a misconduct, which sometimes you can call it as a fraud or maybe in a technical violation. Irrespective of whatever name you call, the point is that if there is a misconduct, it needs to be found, it needs to be corrected, it needs to be punished. Now, here I would like to say the type of efforts SEBI has put in place in the last 5 years is phenomenal. The first and foremost is that what we realized was that all this misconduct takes place using digital devices. Technological advancement has helped the people to devise different types of, whether you use a mobile phone, whether in the mobile phone you use different apps, or you use a laptop, or you use an iPad. So basically, digital devices have been used for the purpose of communication, for the purpose of exchanging certain things. And therefore, the first and foremost thing was, how do we get digital evidence? Because if we do not get digital evidence, it will not be possible for any regulator or any enforcement agency to what you call fix the accountability or prove to the court, prove in the court that so and so has done this type of misconduct. So SEBI has been using the power of search and seizure very effectively in the last 5 years, and the digital devices are being seized from the suspected entities, and for each and every aspect of digital record we create, whether in the form of email, whether in the form of WhatsApp, whether in the form of pictures in Facebook, whatever type of communication we exchange using the what you call digital instrument, SEBI has what you call procured various forensic and digital tools and collect the data, put them together in a particular manner, and then using the different tools and converting, even because we found that many places people don't even send the messages. People record their voice and send it. So from voice to text and text to voice, conversion tools are being adopted, and evidences are being gathered in order to nail the fraudster. So with this development of technology, SEBI has, as you all know, SEBI has also recruited a lot of young people who are more tech savvy than who have joined pre-2000, so that these people are able to adapt the technology, use these tools more effectively, and crack these cases faster than what it has been. So the second aspect is, one is having a very good alert system. We already have in place an excellent alert system, which by using certain various parameters, the alerts are generated. Based on the alerts, preliminary examination is done to identify the suspect entities, and wherever the suspicion is somewhat strong, search and seizure is carried out, the digital evidences are collected, and they have been put in place and then presented in the form of to the entity for the purpose of his or her defense, and based on that, whether an interim order or a show cause notice has been issued. Now, in order to strengthen this further, very important is that in the new Securities Market Code, which is being deliberated by the Parliamentary Committee, it has been said that investigation has to be completed within stricter timelines. Only in exceptional cases, the extension can be given, and this is to ensure that investigation is done on a timely manner. And similarly, the number of cases that the limitation period is being brought in, so that people don't take up very old cases, because the records may not be available in such cases, and it will be a simple drain on the system. And therefore, timelines have been fixed, the limitation period has been brought in, and also what is the validity of the interim order. And with all these measures, I am sure going forward, the chances of people committing the fraud is likely to come down. Even after that, prevention is impossible, because it is a market where people are coming to make money. So therefore, some people will try to definitely attempt to make a quick buck. and therefore the regulator has to keep pace with the, as Mr. Pawan pointed out, whether by using a LLM model or machine learning techniques or whatever technological advancement has to be adapted faster by the regulator to ping these type of fraudsters and ensure that quality evidence is collected. See, it is not the question of what you call preventing the fraud. The important aspect is when evidence is collected, whether that evidence is acceptable to in the court of law. That is where SEBI has to ensure that the right evidence is collected and presented in the right form so that the people who are attempting to do the fraud do not escape from the clutches of law. And once such type of punishment is meted, I am sure people will think twice before attempting to do any market misconduct. And I am sure going forward, I have full confidence that Indian securities market will grow faster. And as you rightly said, with more trust. And I'm very confident that we'll be able to reach whatever is the objective of Viksit Bharat in 2047. And as far as the specific cases are concerned, I will look forward to the other speakers so that we can have more discussion on specific cases. Thank you very much once again. Sir, you are not audible.
I always telling others today, somebody has pointed out to me also. Thank you very much, sir. So thank you, sir, giving it depth and insight of particular thing. And you are absolutely right that we have seen drastically changes since 92 to till date when SEBI came, and we are one of the mature market in the world, not in few countries in the world, we can say. T+1, it is a creation of us. 100% dematerialization is created of India. Even in USA, there are some places outcry system is there. And various other governance measure, governance procedure, related party, various other things are there. So no doubt, we are reaching to the pinnacle, but then it is right. But when you have to make a goalpost, other people change the goalpost. So you have to again work out to reach this. Thank you very much, sir. I will come back to you. I have so many questions for you. But before this, now I will request Madan, sir, to what is happening in the securities market recently. Some cases has been, and you are taking that, you have done the deep analysis of this. Over to you, Madas.
Thank you, Pawanji. Thank you not for only this 267th consecutive webinar, but also for your exhaustive and comprehensive presentation with roadmap for the future. You said digitization, and Sundaresan sir also echoed your views. I've been listening to you, Pawanji, for last 30 years that you have been talking that if everything, Sundaresan sir, please keep your video on. I have a couple of questions to you, sir.
I'm very much gagged, don't worry, because of the...
Thank you, sir. I've been listening to Pawanji for last 30 years, and he has been telling if everything in India is digitized, there'll be hardly any room for any corruption or any fraud. And that is what is happening now. It has started. Now, coming to Sundaresan sir, I tell you, it's always music to the ears. I call him Shankar Mahadevan of securities laws. Uninterrupted, without pause, repository of knowledge, and very rich in experience. Sir, hats off to you. And what I noticed today, sir, I don't know whether others noted that or not. Whenever you wanted to say SEBI, you use the word we. So SEBI is still there in you, sir. SEBI is synonym of Mr. Sundaresan and Mr. Sundaresan synonym of SEBI. Sir, you mentioned some of the cases, and the last but not the least in that was Rajesh Exports, and you were talking about adjudicating officer's order also. On the Rajesh Exports, sir, I have one observation. I would like to have your views on that. That the last couple of some paragraphs are on the directions from the adjudicating officer. And after the directions, there's the last but the one para which says that the foregoing prima facie observations contained in this interim order are made on the basis of material available on record. It's fine. The notices may within 21 days from the receipt of this order file their replies, objections, if any, to this order, and may also indicate whether they desire to avail an opportunity of personal hearing on a date and time to be fixed in that regard. So on the one hand, there are directions or observations with respect to appointment of investigating authority, appointment of forensic auditors, directions to the notices to cooperate with the forensic auditors and investigating authority, and then directions to NAFRA to take care of this auditors. And then this, you have the notices have an opportunity to file their reply and appear before. Appear before whom, sir? That's not clear to me. And give reply to whom? And what will happen? Whether these two things will go parallel to each other. That's my observation, sir, to use.
First of all, under the SEBI Act, SEBI has the power to pass an interim order.
Right, sir.
Now, of course, there has been what you call a spate of observations from different quarters whether what should be the right type of case where interim order has to be passed. Keeping that apart for the time being, in this particular case, what I, like you, I'm also an outsider as of now. So what I observed was that the first allegation is that when SEBI appointed a forensic auditor as part of the investigation, the forensic auditor was not allowed to complete the job.
Right.
These are all allegations. Let me repeat. These are all allegations as per the order that the forensic auditor could only verify 2% of the records or the value of transactions, and 98% of the transactions could not be verified. The forensic auditor has not concluded that those 98% is bad. He says, I think he has said in the report probably that whatever documents produced, I could get satisfied only to the extent of 2%. Therefore, the main cause for this interim order is basically non-cooperation by the entity with the forensic auditor who has been appointed by the SEBI. Because as per the investigation manual we follow, once your forensic auditor is appointed, he is as good as representing the SEBI and he is actually carrying out the investigation. So basically, there is non-cooperation by the entity. So in order to bring this, what you call on record to say that SEBI is passing the interim order mainly because of non-cooperation, number one. Number two, because of this non-cooperation, there is a lot of suspicion. And that is what it says, whether it is a turnover, whether it is a revenue, whether it is a related party transaction, whether it is a diversion of funds, in every area which is being talked about in the order, it is repeatedly says, because of your non-cooperation, we are suspecting this, we are suspecting this. Now, probably had the entity cooperated in normal circumstances, which what happens, SEBI might have got directly issuing a show cause notice, specifying the allegations and what action SEBI is likely to take for the alleged violation. But here, it is difficult to point out what is the violation, except that you got non-cooperation. Because of non-cooperation, I am unable to confirm whatever is being placed in the annual reports. Because of that suspicion, I am suspecting that you might have committed fraud. So everything is because of the underlying point allegation of non-cooperation.
No, sir. My curiosity is that if within 21 days the notices, if they avail the opportunity of giving the reply, and if they avail the opportunity of appearing before, I don't know before whom, whether this interim order be withdrawn, modified, or can be put on rest, can be stayed.
Yes, sir. The practice is like the first an interim order is passed, then there will be a confirmatory order. The confirmatory order can have all three possibilities. Number one, simply confirming what has been sent in the interim order.
Mhm.
Number two, the other extreme is setting aside this interim order. The third, it can be modified and deferred from the interim order. So all three possibilities are there. It all depends upon the response the entity gives, and it is always done by the department and the concerned whole-time member who has passed to the interim order. So it is a practice. Probably there is no need to say, because when you say you have to appear before the same person. Because this
Okay.
is whoever is it, because this is also like a show cause notice. The interim order comes show cause notice. So effectively, the person who has passed this order, you are supposed to submit the records to that office and appear before that person.
So it means the reply, appearance, and the further investigation and further forensic audit may go side by side simultaneously.
Yes.
Okay. That was my curiosity. Thank you, sir. Thank you very much. That's why I always call myself as a student of law.
Security law. Security law.
Now, Pamanji, we are already 5:11. So how much time do I have to maybe discuss in brief couple of
12
those
minutes.
things? Huh?
12 minutes.
12 minutes, that's all. Actually, I wanted to cover three cases, including this Rajesh export. So let me take 2 minutes each for the earlier two cases and maybe for next 7-8 minutes on this case. The first two cases are of 2025. And what is common in those two cases is, in the first case, the company is having, I'm not taking the name deliberately for the reasons known to me only. The company shows in the immediately previous quarter of the financial year 24-25, the company shows a huge profit. And the very next quarter, the company shows a massive loss. And the moment this loss, this unaudited financial results are tabled before the board, on that very day, all the independent directors of the company secretary of the company, the managing director of the company, everybody resigns. And the resignation letter is written personal reasons. Despite LODR very categorically stating that the detailed reasons of resignation shall be given, it shall be written in the resignation letter that the above are the only reasons of resignation. There is no other material reason of resignation. Despite all this, still the independent directors and the KMPs and the compliance officers are resigning on personal reasons, and the effective date of resignation is the date of resignation itself. Because I was surprised, how can a KMP resign? How can a compliance officer resign without handing over the charge to someone? And my same from today's evening, my resignation letter is effective. The other case, I can take the name because Sundaresh sir took the name of Jensol. Jensol, same thing happened. The moment interim order comes, two of the independent directors tender their resignation. Again, on the basis of personal reason, preoccupation in other activities and blah blah whatnot. And one resignation letter, what I tell you, one can laugh at that resignation letter. The independent director is writing to the chairperson of the company, the dear so and so. He is giving the resignation in the month of April 2025 and is writing to the chairman that last July, August, I wanted to speak to you, but I could not. You said you will call back. 8-9 months ago, I tried to speak to you, you said you will call back. Then I wanted to meet the CFO. I approached the company secretary of the company to fix up an appointment with the CFO. See how independent directors are behaving. Independent director is saying that please, to the company secretary, please fix up my appointment with the CFO of the company. But that also did not materialize. I wanted to put up my resignation. Company secretary said, please hold on. One of our associate companies IPO is on. It's going to come. Please hold on. Please don't resign. Now, if the independent director is writing the resignation letter, I wanted to speak to you 8, 9 months ago. It means in between there is no dialogue between the independent director and the managing director of the company. Whether any board meeting happened or not, whether any audit committee meeting happened or not, or all this was simply on paper. So there's a big question mark on these independent directors, or rather I'll say on the entire institution of independent director. Something needs to be done drastically for this purpose also. Now coming to commonly this latest case study of Rajesh Exports, you know what sort of allegations are there, or rather I'll say the observations are there in this interim order, that complete financial misrepresentation. 98% of the turnover is not backed by record, not backed by documents. But whether this entire 15.5 lakh crore turnover is bogus, I have my own doubts. And the order is also not saying that. I think media is also misinterpreting that. It does not say the entire turnover is bogus. It does not say that. It says that it's not backed by document. Please show us the records. And Sudarshan sir also said 2% of the documents are available, 98% of records are not available. If 98% of the records are not available, whatever is there, that has to be that, okay, this entire transaction is under scrutiny. If entire transaction is under scrutiny, does not mean the transaction is not there. Does not mean that that the particular turnover is not there. So then their inflated revenues, their incorrect consolidation of subsidiaries accounts with the parent company's accounts. Very surprisingly, non-disclosure of subsidiaries' financial statements on the website of the holding company. There is a misutilization and diversion of funds, gross misuse of related party transactions provisions, be it under the Companies Act or under the LODR. I fail to understand what independent directors are doing. What they were doing when they were sitting at the audit committee. Investigation is obstructed, as Sundaresan sir said. Non-compliances with the accounting standards. That is the big question on the performance of the auditors, and that is the reason that this matter has also been referred to NFRA for taking an action or do the investigation against the particular those two audit firms which have been involved in this entire scenario during last couple of years, 5 years. Then this is with respect to the company, the notice number 1. The coming to notice number 2, the MD of the company, the CMD CEO of the company, the routing the company's fund through his personal accounts. I've been informed that there was certain tussle between this individual, the notice number 2, and the MCX. And therefore, this entire transaction, the trades were done in the name of the individual, and after that, all these trades were transferred to in the books of the main company. There are personal derivative trading being recorded as company's transactions. Another surprising fact I noticed in this is when I checked the annual report of this company, that this particular noticee number 2, who is MD of the company, he was not MD of the CEO of the company. He was permanent member, rather one of the 3 members of the audit committee. And he used to sit at every audit committee. I was reminded of Satyam, when Mr. Ramalingam Raju used to sit in the audit committee and used to dictate and direct the other directors sitting in the audit committee. Now, if the owner of the company, who is at the helm of affairs of all the issues, all the transactions, all the businesses of the company, if he's sitting in the audit committee, now whether it's an easy task or a very difficult task for the other members of the audit committee who are independent directors to say no wherever they want to say no, I think it becomes very difficult for them. It means they must have said yes, even though they wanted to say no. Now, if we see the directions, Pavanji, the directions are against noticee number 2 only. That is individual. There is no interim direction against notice number 1. And the company, in its reply to the exchange, as well as in its reply, in its press release, taking undue advantage of this, there's no direction against us. There's no fine, there's no penalty levied to the company. It is against some individual against whom this order has been passed. No order as far as company is concerned. Company says that our financials are absolutely correct. Company says we have done no wrong. And I would like to read one paragraph. It says that SEBI has not made any adverse observations with regard to the earnings of the company. It has only observed suspicion with regard to the revenues. So it means the earnings are fine. Issues on the revenues. So, but issues on the revenue and earnings are okay. Issues on the revenues, it means revenue observations of SEBI are not correct. Now, they have taken the loopholes from this interim order, and on the basis of that, they have issued this press release. It further says that we are a debt-free company. Now, Pawanji, the earlier two examples I gave, in those two companies were not debt-free. Now, both those two companies are now under IBC. 99% of the capital market from its peak has eroded. But this company is not a debt company. There's no debt in this company. There is some debt, but that's a disputed one. So this means this company cannot go into insolvency at all. It further says that we have not raised any money from the public since 1995. At that time, we came out with a public issue of 10 crores, and that was the only public issue. After that, there has been split of shares, but no money has been raised from the public. And people are accusing that LIC, nexus between LIC and the company. They say that we have never approached LIC. There is no placement of shares with LIC. So if LIC has taken any decision, this decision has been taken on the basis of their own internal study. They say none of our personal is involved. Company further says we are not indulged in any misreporting. Now, Pawanji, I did some further study yesterday night, and very startling facts came to my notice. That the proxy advisory firms in the country have been reporting against this company for last more than 10 years. Even this LIC of India has been voting against the resolutions on the basis of the proxy advisory firm's report. Now, if they are voting against the resolutions, why these big investors are not exiting from the share? I fail to understand. I just went through the report of the statutory auditors. Absolutely clean report. No adverse finding, no adverse observation. I went through the report of the secretarial auditors. Absolutely clean report. Role of independent directors. Can you believe no remuneration to independent directors? No sitting fees to independent directors. Now, why these independent directors were providing their services to this company? Are they acting a pro bono? They are not expecting anything. They are ready to take all the responsibilities and liabilities without any remuneration. And coming to some of the startling observations, Pawanji, companies holding, now I give one of the examples. Company approves its accounts, the company listed company, it has to approve the audited financial account within 60 days from the close of the financial year. Latest by 30th of May, financial results are approved. Board meeting, the AGM notice is approved in the month of August. See there, May 2025, results are approved. August 2025, notice of the meeting is approved, AGM. But AGM is held in the last week of December. And just 12 days before the AGM, the notice is issued. This is how this company is working and functioning, and the auditors, including treasury auditors and secretarial auditors, giving a clean report to this company. Whole lot of non-compliances with respect to the board and AGM and MGT7. Whole lot of non-compliances with respect to the accounting standards and audit standards. Whole lot of non-compliances with respect to the consolidation of the financial statement subsidiary with the holding company. But surprisingly, everybody's keeping mum. All the professionals, all the regulators, all the statutory bodies, everybody's keeping mum. I think this is a time wake-up call for everyone that this time at least the wrongdoer should not go unpunished. And a message should go to the public, yes, regulator is taking very strict action against the wrongdoers so that the confidence and trust of the stakeholders and the shareholders is restored in the securities market, in the financial market, in the capital market. So this is what Pamanji from my side for the time being. Pamanji, are you there?
Yes, yes. I'm sorry. Yes.
I think
Okay.
some interesting friend is there in your room, I think.
No. One. Uh, so, Madan sir, your observation is right, but my only point is this case is not final
I agree.
decision. So, whatever, because there is stark claims of the management, they are saying that the SEBI has misinterpreted our calculation.
But Pamanji, I have gone beyond the order. Beyond the
No,
order,
I got
beyond
your
the order,
point.
whatever is available in the exchanges platform, and taken the information from there.
Yeah.
I've taken the information from the published records of the company. All this
Yeah,
information is from there.
absolutely right. Absolutely right. The order is there. In the or beyond the order, when there is something is happening, then people also inquire and investigate. And you have identified certain things. Let's wait this because this is a very live case and happening. No doubt, prima facie are looking so much grave information, grave things in this. Let's wait what SEBI is saying, and whatever your input is there, pass on to SEBI. That will be very useful for everyone. That is a requirement which I have mentioned in the beginning. If we all will be the policemen, then there is no crime in the country. That is the most important thing. So now, after listening to the two giants of this particular thing, I will request Ravi and Kirti, please take up this. And because your session is relating to the nitty gritty of these fraud, how it is taking place, what are the things, we all have given you the upar ka funda. But now you please tell us what is happening, how things are happening. No doubt, time is short. So I will request you certain things which is not very important. You just pass on. And over to you, Ravi and Kirti.
Thank you so much, sir. I am on a very limited network bandwidth, so I'll not be switching on my video for now. I see if the bandwidth improves, I'll switch it on later. So I'll just quickly take you through the definitional aspect of fraud under securities law and how it has evolved after this Reliance order that is passed by Justice Pardiwala and what he has observed. So we all know there is a fraud triangle. There has to be a motive, an opportunity or access to commit fraud, and then rationalization. And that fraud is something that is shaped by greed and fear, and it exploits both. Thereafter, if you see all the legal frameworks on fraud, leaving aside the criminal ones, the Contract Act, the Companies Act, and the Securities Law, you would find that it deals with an act or omission or abuse of position, which is the conduct-based assessment. Then what is conspicuously silent, at least in Companies Act and Securities Law, is the state of mind assessment. And the third one is also not an essential requirement, is the impact assessment. So if you committed a fraud or if you attempted a fraud, regardless of whether it yielded into wrongful gain or losses, and I'm saying it historically, these were the assessments or tests that were applied to check whether there is a fraud or not. And the conduct test played a huge role in that. We will just try and understand what changed after Reliance. And does it change at all? Or it's just an exposition which is maybe in one way simplistic, in other more complex, but ultimately boils down to the same thing. So the logic of fraud is very clear in regulations. What has happened in the Supreme Court's case, which the judgment was delivered on May 29th, before I deal with the fraud issue, I'll just quickly talk about a very important legal principle that Supreme Court settled in para number 145 of its judgment. They said that a consequence of violation cannot be read into the provision. So if a provision only provides for a penalty for doing or not doing an act, or for committing an omission, one cannot read some other consequence for that act or omission. Many a times, this comes to us as a question from clients, from people, that what happens if this transaction or this particular thing runs into violation of the provision, even though it's technical? What could happen? Could this transaction be nullified or be called void? So I think the Supreme Court has clarified that the consequence has to be strictly read, and one cannot read the consequences into the provision. It has to be clearly spelled out in the provision, can't go beyond it. Secondly, what they observed in para number 169 is that while the definition of fraud under regulation 2, subregulation 1, clause C of FUTP regulations require no proof of intent, and this is the catch-all portion of the definition, the subsequent part, which delineates specific instances, uses the word inducement, and the inducement brings into ambit the element of intent. So therefore, what Justice Padiwala observed was that there is some internal contradiction in the definition. The catch-all part says no intention required, whether it was deliberate or not, intentional or not, deceitful or not, regardless, it could be fraud. But that subsequent part relies on inducement. So what he has done, he read together the first part and second part, tried to harmonize it with purposive construction. And this is what now is the rule for testing whether there has been a fraud or not, and how to prove it. Where there is injury, if there has been a legal injury, and this is in para number 175 where these twin tests are given, if there has been injury owing to a wrongful act, and that is proved, then there is no need to prove deceitful intention separately. If deceitful intention, and this is the second test, if deceitful intention is clear from the conduct itself or the attending circumstances, then there is no need to prove injury. So if the injury is there, no need to prove intention. If the intention is proven, no need to prove injury. And what they significantly decided also is that a breach of a violation does not automatically becomes fraudulent. For fraud, it has to either satisfy the condition of actus reus or mens rea. But Justice Padiwala clarified that he is not using these two words or terminologies in the strict criminal sense. Now, this is how, after the Reliance judgment, the law is going to shape that the basis for someone to fall under the definition of fraud, which has been amorphous for nearly 2 decades now, and anything and everything in the stock market could have induced somebody to deal in securities, could very well be termed as fraud. Now, there are some goalposts set by Supreme Court, and there are some fundamental tweaks made in the way you assess a fraudulent conduct and the evidentiary standard, although the evidentiary standard has not been altered much. But mens rea and actus reus is categorically stated by Supreme Court that these cannot be called irrelevant. So I think we have moved far away from Cabot and those line of judgments which were inconsistent with each other. Even up till Kanhaiya Lal Baldev Bhai Patel, there were certain inconsistencies that this judgment records. And it says now you have to either prove either of the two, at least. With this, I would now pass the baton to Kriti. She has done a great deal of work in securities law enforcement area, from GDR fraud to charges of insider trading to fraud of varied nature, pump and dump and others. She has handled it firsthand alongside the team. So Kriti, over to you. You can tell us about where fraud occurs and understanding the securities fraud from the classification lenses. Over to you.
Thank you, sir. So, a useful way to understand securities fraud is to ask four questions. Where did the fraud occur? Who participated? How was it executed? And why did it succeed? For example, a pump and dump case may occur in secondary market, be carried out by operators or influencers, be executed through YouTube or Telegram, and succeed because investors respond to urgency, social proof, and unrealistic return claims. So, where fraud occurs? Fraud may enter the securities market at different points in the market life cycle. In the primary market, the fraud usually begins at the fundraising stage, where investors are persuaded to invest on the basis of an offer document, prospectus, issue structure, or stated object of raising funds. In the secondary market, the fraud usually appears in trading behavior, where price, volume, order book, liquidity, or market demand is artificially influenced. In the off market or demat layer, the fraud may not be visible on the exchange screen immediately, but it may appear through transfer of securities, pledge misuse, client securities misuse, or beneficial ownership concerns. Increasingly, there's also a digital information layer where investor conduct is influenced before the trade is even placed through social media, messaging platforms, videos, or online recommendations. The key point is that fraud may start in one place and show its effect somewhere else. A misleading disclosure may lead to trading activity, an IPO proceeds issue may become a fund flow case, and social media recommendations may become a secondary market manipulation case. Modern securities fraud is rarely the act of one person acting alone. There is often an originator, an enabler, an operator, and a beneficiary. The listed company or promoter may create the disclosure or fund flow issue. An intermediary may provide access or execution. A trader or operator may create artificial market activity, and so on. This is why SEBI's analysis is not limited to the name in which the trade was placed. SEBI looks at who controlled the information, who controlled the account, who gave instructions, who moved the funds, and who ultimately benefited. In that sense, role attribution becomes central. The visible account holder may only be one part of the chain. The method of fraud changes with market structure. In older cases, focus was often on price rigging, circular trading, synchronized trades, or accounting manipulation. In most recent cases, the same fraudulent objective may be achieved through social media amplification, mule accounts, false corporate disclosures, derivative or index positionings, spoofing, unregistered advisory, or fund flow structures. The important point is that legal labels comes after the factual pattern. SEBI first reconstructs what happened, what signal was created, who acted on it, how the market responded, and who gained from it. Now, the mindset behind fraud is also important to recognize. Some violations begin as negligence, disclosure failures, weak controls, audit lapses, or careless systems. Some begin as opportunistic conduct, gray zone trading, front running opportunities, wash trades, misuse of IPO proceeds, or loophole exploitation. Some are intentional and malicious, such as pump and dump, Ponzi schemes, accounting manipulation, insider trading, or deliberate fund diversion. The emerging category is technology enabling fraud, such as AI generated announcements, deepfakes, fake trading apps, social media manipulation, and greenwashing. Fraud persists because behavioral drivers meet governance and detection gaps. Greed, fear, pressure, and rationalization creates the human driver. Weak boards, poor controls, and audit gaps create the opportunity. Illiquidity, volatility, FOMO, and information asymmetry create the market condition. Digital channels, mule accounts, and delayed whistleblowing allow the fraud to remain hidden for longer. A fraudster typically creates pressure, builds a narrative, uses access, amplifies a story, and then exits. Now we'll go through some fraud typologies and case studies, which have already been gone through the previous speakers. So next we'll move on to the recent securities market fraud and what SEBI looks at in these type of cases. So, in order spoofing is an order book manipulation strategy. The false signal is created by placing large visible orders which suggest demand or supply and then canceling those orders before execution. SEBI therefore does not look at only executed trades. It also looks at order logs, placement timing, cancellation timing, price volume effect, and account links. Large cancellations by themselves are not fraud. The issue is whether cancellation pattern shows false death, intent, or effect and market impact. Front running is information abuse. The front runner trades before a large client or institutional order and exists after the expected price movement. The chain is usually information source, information carrier, front runner, mule account, and profit extraction, following the pattern of BBS or SSB, as shown on the screen. SEBI looks at repeated common script days, big client order timing, dealer links, call records, MAC or IP data, fund flows, and matching percentages. The key is repetition. One trade may be coincidence, a sustained pattern across multiple script becomes evidence. Now, in misappropriation of IPO proceeds, the issue proceeds are raised for disclosed objects. If the actual movement of funds does not match the RHP objects, that becomes a serious regulatory issue. SEBI looks at RHP objects, issue proceeds, bank trails, bank statements, monitoring agency material, merchant banker instructions, board approvals, and utilization certificates. A corporate announcement is market information. If a company releases exaggerated or unsupported information, it may affect price discovery or investor decision making. So, some examples of these cases were Gensor, Rajesh Exports, and RHFL, which have already been discussed. Next, we move on to pump and dump. Pump and dump follows a simple playbook. First, the operator builds a position, then a story is created, then the stock is pushed through a platform, then amplification happens through paid groups, videos, messages, or informal tips. Retail demand is created, and finally, the operator exits. In Sadhana and Sharp Lines, SEBI examined false and misleading YouTube videos, paid campaigns, lakhs of subscribers, crores of views, increased price and volume, net sellers, and connected entities. In Sadhana, SEBI recorded links to family relationships, KYC details, common address, email IDs, call data records, and fund transfer. The channel may be YouTube, X, Twitter, Telegram, WhatsApp, or SMS. The economic structure is the same: create attention, induce demand, and exit into that demand. The 2026 stock recommendation case, which is an interim order passed by SEBI, is the latest version of the same problem. SEBI prima facie observed use of X handles, WhatsApp groups, Telegram channels. The alleged pattern was buy before the recommendation, push the recommendation, wait for price movement, and sell after the rise. SEBI examined 82 scripts and computed around 20.25 crore as prima facie wrongful gains. The evidence included seized devices, CDR, exposed, Telegram, and WhatsApp data, among others. The ex handler of the operator said it was not giving recommendations and that the views were only for educational purposes. However, SEBI's approach was to look beyond the disclaimer and examine the product, whether positions were built first, whether stock specific posts were made, whether those posts were amplified through WhatsApp and Telegram, and whether connected accounts sold after price movement. The legal point is important. Educational purposes only is not a defense if the actual conduct is stock specific inducement. Now, last year, the index manipulation case is different from the classic penny stock manipulation. In the Jane Street's interim order, SEBI looked at alleged cash equivalent or data equivalent exposure, expiry day concentration, cash F&O linkage, and extended marking close. SEBI's order discusses profits in index options and losses in underlying constituent stocks and futures as part of its analysis of the alleged strategy. Large hedges, arbitrage, expiry day trading, or cash F&O linkage are not fraud by themselves. Manipulation must be cogently established. Financial statement fraud affects the securities markets because investors trade on published financial information. Satyam is a classic case of inflated assets and false cash and bank balances. DHFL is different archetype, loan book camouflage through Bantra book entities, and fictitious or mischaracterized retail housing loans. Rajesh Exports, as already discussed, is also a financial statement opacity case. The line to remember is this: corporate or accounting fraud becomes securities market fraud when false or unverifiable information distorts market disclosure, price discovery, or investor decisions. Fund diversion often appears legitimate at the first level. The chain usually looks like this: sanction or raise funds, disburse, onward transfer, camouflage, and then write off or extraction. In RHFL, SEBI found a fraudulent scheme involving loans to credit unworthy conduit borrowers and onward transfers to promoter linked entities. In these type of cases, the lesson is that SEBI does not stop at the first disbursement. It follows onward transfer, related parties, write-offs, and benefit extraction. Now I will request Mr. Ravi to handle the how SEBI builds a case as to how SEBI and what all SEBI looks at when making a case against an entity.
Thank you, Kriti. So I recall the prescription given by Supreme Court in Kishore Ajmera. In Kishore Ajmera, they said that seldom it would happen that in a securities law violation case, you would ever get a clinching evidence or a blood tainted knife of the crime as evidence of the crime. So, what do? Do you make regulator a toothless tiger? Can't do anything about it because there is no clinching evidence. That's where they read in what has been a classic standard of evidence, as stated by Lord Denning, the more likely than not test, which is also called preponderance of probabilities test. How the SEBI builds the case, what is the evidence pyramid looks like? They see the conduct, inference, and legal theory. They run through the corporate and disclosure records, bank, demat, and fund flows, social media trail, communication trail, the price volume impact, order and trade details. You can basically categorize it into three categories. One is the trade and order based evidence, which is the trading conduct assessment. Second is the slew of digital evidence running from your social media handles to your digital footprints to the CDR and your IP location, and also towards the account control evidence. So they check your social relations, who you're talking to, around the attending circumstances when either a front running trade has happened or somebody has, based on a tip, took a heavy position in a script at the time when some UPSI was about to be published. So they see all the attending circumstances. And sky is the limit for SEBI to check and draw a coherent chain of evidences by using different mosaics. So we call it a mosaic theory, in which they take different shard of evidences, put it together, and build a coherent chain, which in absence of a clinching evidence would speak about the conduct of the person charged with a violation or somebody who has abetted or aided the person who's charged with the violation. And this mosaic has been working well for SEBI from cases as varied as dealing with synchronization of trades to these new generation fraud of spoofing or front running, which are skyrocketing anyway. So, all in all, what SEBI does is to build a coherent chain of evidences which show the conduct of a person to not be of a reasonable person. And on preponderance of probabilities, what SEBI does is they rule out all other possibilities of the innocence of that person, so that the only hypothesis that is sustainable on logical and reasonable grounds is that of guilt. And that's where SEBI's path towards bringing guilt home for a charged person becomes clear. But then there are problems, mathematical, logical, and legal, with this concept of preponderance of probability. This is not a 50% or more test. This is a test of subjective satisfaction on every level. And with the reverse burden of proof not acting in this piece of legislation, at least at the onset, any benefit of doubt has to go to the charged person. So many of time we have seen that SEBI could not bring the guilt home. But nevertheless, in whatever cases it could bring, that has been phenomenal. And from tracking mobile tower locations to bringing out connections between people who said in their testimonies that we don't know each other, and then SEBI found their photographs traveling together or connected through social media, or they found them to be having met at a location immediately before UPSI was exploited. These are something that SEBI has done phenomenally well in comparison to other regulators. And that's about it. I mean, it's a different topic in itself. 5-10 minutes are not enough to conclude this. So I think I'll pass the baton back to you, Kriti.
Sure, sir. Thank you. So now I'll deal with the red flags and how to prevent. Fraud prevention is role specific. Investors must watch social media tips, unrealistic returns, sudden price volume movement, and repeated upper circuits. Intermediaries must watch suspicious order patterns, connected accounts, mule accounts, and IP device linkages. Boards and auditors must watch disclosure controls, related party opacity, fund diversion risk, and audit trail gaps. For investors, the first risk is a source of information. If the same stock is being pushed across X, Telegram,
Kriti,
yes, sir.
I think the important point you cover, because we have to take some question answer also. Okay. So just quickly, the important points you cover.
Sure, sir. So the important point is basically that what all the investors, the intermediaries, and the companies, the internal governance of the company must watch out for, so as to avoid any fraudulent activities. Now I'll just end it with these are the prevention frameworks for the investor. The need to verify the exchange filings, check price volume history, independent verification before investing, and before acting on any advice they need to check the SEBI registration, reject guarantee framing, ask for full risk disclosure, and so on. Even the brokers and intermediaries must check the employee controls, surveillance, accounts, and KYC. And the listed companies must have disclosure controls, financial reporting, and fund use controls, so as to avoid any fraud. The regulatory response and way forward has already been dealt by Pavan sir, so that the long term, medium term, and long term advice and the suggestions for SEBI to detect and to survey any kind of fraudulent activity in the market. Lastly, we must try and ensure that we protect the market integrity and preserve the investor trust. Thank you.
Thank you very much. Thank you, Kriti Ravi, for covering this, because we have to cover some questions. That's why, sir, I'm directly coming to you about this particular questions. when you were there in SEBI, my uh, my very important question, though I'm interacting with you, SEBI, and other people, why SEBI is not communicating that how much, uh, like CCTV, that somebody putting CCTV, they are saying CCTV ऊपर वाला देखता है. So crime is automatically reduced. Why it is happening that SEBI has so much detailed analysis, detailed discussion. Even SEBI is not communicating to the market that how we are conducting each case. Like I have seen your order, so many orders which were very innovative. So can you just tell me, if SEBI is telling and communicating that what we have done in this case, it will not restrict others to do. I'm not saying that they will not search another route, but at least the simpler route or some route which you have made them more complacent, more complicated, they will do something. So the crime chances and the manipulation chances will reduce drastically.
Thank you, Mr. Pavan. And first of all, I must thank Ravi and Kriti for doing such a detailed research as to how, again, as Magan said, I will use the word we have been working. So I don't think even in SEBI, we would have tried to prepare a sort of a dossier, how we are tracking the cases. But Ravi and Kriti have done a very good job. Okay, compliments to them. Mr. Pawan, I think the answer lies in Ravi's presentation. No regulator gives this much of details in an order. In fact, we used to debate whether are we putting all our cards in an order, disclosing each and every aspect what we have done. For example, as Mr. Ravi pointed out, in few cases, we have gone to the extent of how the person carried the mobile and traveled from place X to Y, and from Y, the other culprit joined in, and from place Y, how A and B traveled together to place Z, where they actually a sort of plan to do something. So this entire movement of A from place X to Y and B joining A in place Y and traveling along with him, everything is not only written in English. The movement of the mobile tower, their mode of transport, everything is being disclosed in an order. I don't think any regulator, at least in India, I am confident because I am not such an internationally aware of that. No other regulator in India puts so much of detail in their order. And in fact, our concern at many points of time was that are we disclosing more than what we are expected to disclose? So I don't think any order is short of disclosure as far as what SEBI has observed, how SEBI has observed, why SEBI has observed. All these things are covered very much in detail. At times, I also felt that it is more than what we need to disclose.
Okay.
Please cite an order where it is deficient. I think we should take up that type of case and discuss if at all any such thing is there, which I am doubtful it may not be.
Okay.
May I comment on this?
Yeah.
Now, if I discuss about this interim order in Rajesh Exports, some of the professionals in the market are saying that why so much details have been given in this order. Only the operative part should have been given, and rest of the things should have been communicated to the company and the management only. Because of these details in the order, now they are seeing that the thousands of lakhs of this net worth market cap has been eroded, and that this downward freeze is not going to happen unless the price comes down to 5% of its peak. So they are saying that these details were not required at this stage in the interim order at least.
Okay. Sir, can you tell me, when you have done investigation, which case you think it was out of box and you were successful. When you selecting your case, I know the number of cases. You are communicating to the market also that they should feel that what we are doing, thinking that nobody is watching, SEBI is watching, or they can crack it also.
It's difficult to point out any particular case. One thing I can tell you is that I have worked in investigation pre-COVID time, and I worked in surveillance post-COVID. I realized that, and as per the system, generally surveillance department of SEBI sends cases to the investigation for detailed investigation. So what we did was we started using the power of search and seizure post-COVID. That is somewhere in 2020, we started our first one, maybe the second search and seizure. First one was done before in one of the financial results WhatsApp leakage case. So subsequent to that, when we did search and seizure, the amount of digital evidence we got, that was the way, according to me, we should have done investigation even before. Of course, everything is an evolution, we can't apply, even in the Reliance case, I was telling somebody, the case is 15 years back, charge sheet was made by SEBI. Now, the Honorable, respectable Supreme Court applies wisdom of 2026 for a charge sheet which was prepared in 2011. That is 15 years back. So everybody learns. But all those cases which I have done post-COVID using search and seizure, every case was a unique case because the amount of digital evidence we got. There are cases where we could get Instagram pictures and reels which are being made by people where they are claiming to have done something great, which actually helped to nail them. So every case is a unique case, and it is difficult to say that. But the underlying point is the way digital evidence can establish the case, nothing can match to that. You are on mute.
One case, you please tell us where you think is the best case you have cracked, which is on prima facie, it was not looking something suspicious.
No, sir. I don't think it will be appropriate to name any case as such because it's better to stick to general rather than specifics.
Okay. Sir, now what your suggestion, because when you relinquish your charge from SEBI, 1 year, around 1 year is taking place. In the entire period, AI is taking over something greatly. So what do you feel? What people will do through AI? I have suggested, I have given some example. And what is the preparation SEBI should do?
I understand that there is a roadmap which has been drawn. SEBI doesn't wait for the market to tell them what they have to do because SEBI has been very proactive. SEBI has already started adopting various digital and forensic tools, both for prevention as well as for collecting evidence in places where there is a suspicious manipulation or fraud. So it's very difficult to point out. As I said, we are, already procured certain tools and then very customized to our requirement as far as email, analysis is concerned, or WhatsApp is concerned, or facial detection is concerned. For all those things, SEBI has been moving in the right direction, adapting more technology, and even for writing of reports and putting together evidences. LLM models are being developed by the department people along with the technology department. So SEBI has been proactive in adopting new technology, and I don't think anything specific I have to tell because over a period of time, the management is very clear as to how fast they have to adapt.
Okay. Sir, what message you want to give to the investors, sir?
See, first of all, I wanted to tell it is not only for the investor, whether it is a corporate employee, KMP, SEBI has come out with a very modified system of informant mechanism. Unfortunately, not a single case has come in that. And it has been modified not once, I think twice. Now, SEBI has also come out with a very attractive reward mechanism. The unfortunate trend is that the person who wants to complain, I do not know why they are not coming with some more details and take advantage of that informant mechanism. There was a discussion, both within as well as from the market, whether this informant mechanism, which is available today for an insider trading case, can also be extended to FUTP, registered fraud and unfair trade practices regulations. That the concern was that if it has not picked up in insider trading, what is the guarantee that it will get picked up in the other one? So my first request to the market participants is that they should take advantage of this. And SEBI has put lot of protection for the informant. His name will not be disclosed at any point of time. He may not be tech or legal savvy to present the case. He can use a attorney for his a lawyer or a representative to file the case. Both the secrecy of privacy of these people will be protected very well. They will also be rewarded. There is an interim reward. There is a final reward. The calculation is also given in the regulation itself. So people should come forward. If something can be nipped in the bud, I think this type of system has to be utilized. The second is, as Mr. Magan pointed out, governance over a period of time has been improving, but there is a lot of scope for improvement. People, I have seen some cases where people say we resigned from a particular company due to health reasons. But within 15 days, they are joining another company. Now, it is health of whom? Health of the person who is resigning or health of the company? So, I mean, at some point of time, even those people have to be more educated. And then they also have to be careful when they resign, when they point out something. They have to engage. See, not necessarily as rightly pointed out by Madan in that Rajesh Exports case, every transaction where there is some doubt need not be fraudulent. Sometimes the details may not be available, merely because non-availability of details does not make the transaction, what you call the fraudulent from the beginning. So people need to engage. People need to trash it out with the proper communication, because by doing something, the damage it causes is more than what the benefit it would have cost had there been a dialogue. Now, because of these things, the downside is that as a regulator, there is always a perception that every wrong, every misconduct can be corrected by writing a new regulation. Although the ease of doing business, reducing the regulatory burden, reducing the compliance burden, these are all very well spoken, very well debated. But when it comes to the actual factual position, actual and realistic position, new regulations are written without deleting the old ones. So the more the more misconduct is observed, more the regulations are written. And I am one who has been believing for quite some time, and you know me for more than 25 years, that by writing more regulations, misconduct cannot be reduced. Beyond a point, law cannot change the misconduct. Law has its own limitation, and people will start interpreting it in a different way, and it will create more and more problem. Only by conduct, only by culture, only by education, the governance standards can be improved.
Okay. Madan sir, your message to the investor or the market.
Be vigilant. That's all. Be vigilant from all angles.
No, vigilant, this is a very okay. Ravi, what is your message to investor in the market?
I think I would repeat without repeating what Sundareshan sir has said.
Okay. So you have dot D, comma, so same too.
Yes.
Ditto.
Kriti,
Ditto.
yeah.
Same, sir. Being vigilant is most important.
Okay. Okay. So I think it's a time to close. We have already crossed because the topic was very, very exhaustive and detailed one. No doubt, sir is saying absolutely right. Kriti she has prepared in detail. And sir, these all presentation will share to you. So you can see this and their presentation was for 1 hour. But because of shortage of time, we have cut short. And Ravi is traveling to Indore. He has gone to Mahakal. So he is attending a program from that side. So Ravi, from everybody's side, please pray for all of us also, for the capital market, for everybody's well-being. Sir, it's a time to close now because the session has given a clear message that the market is improving simultaneously. The fraud is also improving. Market is taking new dimension. They are taking a new dimension. Market is thinking of something using technological tool. They are also using some other tool. Yesterday, it is just I'm just informing you, sir, very differently. But if this is happening, it can happen. My cousin came and he showed me one programming. So what he was doing, he was using this programming for their debtors, those who have not paid money to him. So there was a app where you feed number. So I'm feeding Sundareshan such number. And I'm saying, Mr. Sundareshan, you have not paid my 1 lakh rupees. Please pay. Or my invoice is pending since long. Whatever message you want to give. Now you will not believe, sir, every minute call will come from this. And if you are blocking that number, it will not come from the same number. It will come from different number. Yesterday, he has showed me the demo and I received these calls and you can see, sir, all these numbers which I have received yesterday, they were from this. And he mentioned, Chacha, you have not paid my invoice since long. So all these number I was blocking, some other number was coming every minute. Now this is this is not a negative thing. This is something, but I can create a CEO voice. I can make a video. I can put it on the system that I'm getting this order, I'm getting this order, I will do this, I will manufacture this, and market will react on this. And sir, market reaction for 10 minutes is sufficient, sir, for destroying or making money. So all these new things are coming in the market, and SEBI and everybody has to be more vigilant to catch this. No doubt, fraud is not with one investor. Fraud is few investor. No, it is ultimately it is damaging the country's image, and it is damaging the capital formation, and ultimately it is damaging my employment, my business, my tax, my GDP growth, everything. So capital market evolution is very, very important, and this should be treated as sacrosanct, not that any Tom, Dick, and Harry can do some manipulation in this. We will continue. Sir, you want to say anything? I just want to close this. Anyone, any last comments on yours? Sir,
Fine, sir.
yeah. You want to say
Fine.
something? Yeah.
Everything fine. You have summarized very well.
So with this, our knowledge sharing journey will continue. Our next webinar of 268 will be on next Friday with new topic, something new, with some new speakers, new panelists, and new problems of the corporate world. With this, till then, thank you very much.
Thank you.